What's going on, y'all? Happy Monday and welcome to episode 3 of Hashing It Out. I'm your host, Colin Harper, head of content and research at Luxor Technologies. Today, we're going to have the usual hash rate index data breakdown, looking at hash price, ASIC prices, as well as looking at transaction fees and some of the movements we're seeing there and kind of some historical reference. And for the news section, we're going to be tackling the White House's recent report on Bitcoin and crypto asset mining, and wrap up with a little post-merge analysis of where are miners going to go and how much hash rate can alternative proof-of-work GOP mineable chains like ETH Classic and Ravencoin actually absorb from the current Ethereum hash rate. So with that in mind, let's dive right into it, starting with the data from Hash Rate Index. So Bitcoin's hash price is getting a little bit of reprieve over the past few days. Bitcoin hit a local low of about, I think, 18.7 thousand over the weekend. And as you can see, hash price dipped accordingly to about 7.75 cents per terahash per day. Now, these are some of the lowest. This is some of the lowest we've seen hash price go since, I think, June or July. Let's go look at the 3-month here. Did we get lower? Yeah, I guess just about the same as what we hit back in June. June 19th looks like we have a low of just over 7.75 of a cent. And it looks like over the last week, we actually went a little bit lower than that. So that's the lowest we've seen hash price go in quite some time. The all-time low, as we've said in prior live streams, was back in late September of 2020. And last week, coinciding with a pretty severe difficulty adjustment and Bitcoin's price plummeting, we got closer to those lows once again. But over the weekend, Bitcoin's price did a bit of a U-turn. Currently, according to Hash Rate Index's Bitcoin Price Index, we are at $22,125 for Bitcoin. And as a result, you can see hash prices bounced back up to 9 cents right now. The spot right now is 9 cents and some change. So definitely like to see that. I wouldn't be holding my breath, though. You know, there's not much volume right now going on Bitcoin exchanges. And who knows if this rally will last, right? Like, the macro landscape has not changed very much. You have some people calling that this is a reversal. Some people saying that 18K was the bottom. You know, I'm not a trader. I don't like to do that analysis, so the jury's out for me. I wouldn't be surprised to see lower prices still. And for hash price in particular, obviously, we've got some headwinds coming our way. For instance, the next difficulty adjustments looking like it's going to be in the realm of 3 to 4%. Block times for this epoch have been 9 minutes and 39 seconds on average. So we're still going to see some more positive movement for the difficulty adjustment. This next one will set an all-time high difficulty. It looks like it'll come in the next day or two. So, as for whether or not this hash price rally will last, I'm not holding my breath for that. Now, one of our listeners on YouTube commented that he would love to see some analysis of transaction fees. So we're going to spend the second half of this data segment before we get to ASIC price index looking at transaction fees really quickly. This can be found on our network data section on Hash Rate Index, and right here is the chart. So as many of you probably know, and this is not going to show on the 1 year, but we're going to look at the all really quickly. As you can kind of see right here in 2021, Bitcoin fees used to be pretty substantial. During the bull run or the early parts of last year's bull run, it was not uncommon to see fees upwards of 10% of block rewards. And then the China mining ban happened, and then they dropped to 1 to 2% of block rewards on average. Now, there are multiple reasons for this. I'm not going to get into a lot of them right now because a lot of them involve some speculation. But as we can see, after the Chinese mining ban, fees as a percentage of block reward just get completely obliterated. So where does that leave them for the past year? Well, they've been pretty steady, honestly. Like, there haven't been too many fluctuations in fees. As you can see, they usually bounce between 1 and 2% of block rewards. For those of you who follow the Hash Rate Index newsletter, it's very rare that we get a week where we see fees above 2% of block rewards. But we did see them exceed 2% of block rewards on a weekly basis in the summer of 2022. Now, a lot of this has to do with, I would say, panic selling. Bitcoin was tanking at this time. And when Bitcoin tanks, people move their Bitcoin. Block space becomes more scarce because people are trying to get their Bitcoin onto exchanges to liquidate, right? And if you have a lot of Bitcoin, or even if you want to get out before you see the price fall more, you're going to be more likely to pay a larger fee, right, to get included in block space immediately. And that's a lot of what we saw in June and July, right? I think, as you can see here, fees peaked on July 13th as 4.7% of block rewards on average. And since then, they've kind of receded. We've seen it go back to that 1 to 2% average and kind of setting, setting local lows. And in some cases, as you can see from here, even going lower than 1% on average on the daily. So as for right now, block rewards or fees as a percent of block rewards are at, monthly lows. I don't really see this changing anytime soon unless we see some drastic changes to Bitcoin's price. For instance, if it starts tanking again, maybe this will go up. That's a kind of cold comfort, right, for Bitcoin miners, because at the same time that we're seeing fees become a larger percent of block rewards, therefore giving a little nudge to hash price is getting crushed by Bitcoin's price, right? So if that does happen, not really a win for Bitcoin miners in general. But all of that to say, fees kind of at a low point right now. Don't really see signs of this reversing as the block space isn't really in demand. We actually usually see block space, become more scarce in times of a bull market, and in bear markets, the only time it becomes scarce is when people are panic selling. So with that said, going to move on to ASIC price index. Not too much to report here. It's kind of becoming the same story week in and week out. It seems like prices are stabilizing a little bit. We did not see very much movement last week in terms of ASIC prices. The under 38 joules per terahash band, so your most efficient new gen equipment, budged by, not even $1. It looks like it only budged by basically 50 cents. The 38 to 68 joules per terahash band only changed by 1 cent per terahash per day. And the above 68 joules per terahash, your S9s and so on, that budged by about 40 cents. But there aren't so many data points for that lower band. They're becoming increasingly hard to source because people are just not trading S9s in lesser efficient hardware. So not too much movement on the ASIC price index front, kind of repeating what I said last week. We expect prices to come down further from here because the ROIs for even these prices are a little bit higher given the current hash price and the forecast we have than what some buyers might want them to be. And on that note, a quick update for the ASIC price index. We will be adding a new band to the index to factor in the S19 XP, and when it comes out, similar hardware. This will be a under 25 joule per terahash tier, and the changes accordingly to the index will be as follows. We will have that under 25 joule per terahash for the most efficient equipment. Then the next most efficient will be 25 to 38 joules per terahash, and then we will be keeping the 38 to 68 joules per terahash and over 68 joules per terahash as well. Though towards the end of the year, we will probably look to phase out the over 68 joule per terahash band, just because, like I said, it's becoming harder and harder to actually source data points for that band because people are not trading them on the secondary market nearly as much. So be on the lookout for this change. It should be coming sometime in October, early October. We will make more announcements about it as we get closer to the date, and obviously we will notify everyone when we actually make the change. Now, with all of that in the books, let's go ahead and turn over to our number one news item for today, which is the White House's recent report on the climate and energy implications of crypto assets in the United States. Now, this made the rounds a lot on social. I know a lot of y'all probably already saw some analysis of this, but we had to cover it here because this is, to date, the, the clearest indication that the federal branch of government has given its citizens that it is paying attention to Bitcoin mining and that it doesn't really like what it sees. From here on out, we expect more scrutiny from the federal branch of government and also the legislative branch of government. And all of that to say, with this report as kind of the cornerstone of policy going forward, it seems we expect there to be a lot more pushback and also potentially some regulations from federal branches of the government. So to kind of give you the TLDR of this report, it's kind of what you'd expect, right? The White House thinks that Bitcoin mining sucks up too much energy, and they're also saying that this could hinder climate goals. Some of the data that the report uses is, in our opinion, flawed and biased. A lot of the data that the report cites comes from one Alex de Vries, who runs DigiEconomist. Alex de Vries is a former employee of the Dutch Central Bank and also has some pretty inflated statistics for how much energy Bitcoin mining actually uses. It's several, several degrees higher than some more legitimate research we find, including some research that we've done ourselves at Hashrate Index. Just want to flag this for people to see really quickly. We added this energy markets tab last year, and this gives a upper bound, lower bound, and a base case scenario for Bitcoin's total energy consumption. And as you can see from this right here, our theoretical upper bound is 17 terawatts of energy, and our theoretical estimated consumption is about 8 terawatts of energy. So in this report, they did not cite Hashrate Index as much as we would like them to, but they did take a look at the Cambridge energy consumption index, and I'm going to try to find that. But before I do that, I just want to go to this quick takeaway. Let's see. I believe they found that Bitcoin mining uses, as much energy as Australia in a year, and this is equivalent to 0.4 to 0.9% of global electricity uses. As you can see, it's a pretty big delta between the lower bound and upper bound on this report. The lower bound comes from the Cambridge Energy Index data, and you can find their breakdown right here. And that best estimate is 88.6 terawatt hours a year. And the upper bound comes from DigiEconomist, who gives a best estimate of 144.9 terawatt hours a year. Now, I haven't looked at Alex's methodology in a while, but I recall from previous glances at it and also some analysis that I've seen from other commentators on Twitter that this uses some pretty low efficiency. This basically uses the lowest efficiency equipment you can find, right? It does not really factor in what we would consider a practical and actual accurate estimate of the actual hardware that's out there right now, and uses some of your older models like the S9, right? Cambridge's data is generally pretty solid. It's some of the best out there in terms of general estimates, and they update it, I believe, daily or hourly. You can find that right here. And as you can see here, they estimate that the Bitcoin shares of electricity is 0.34% of global electricity produced and 0.15% of global energy production. Now, there are other estimates as well from the Bitcoin Mining Council. I definitely recommend everyone check those out. But these are the Cambridge's has kind of become, at least in academia, the gold standard for citation. Now, a few other takeaways from this report that one of my colleagues, Ben Harper, covered in an internal memo to the Luxor team. The report makes a number of policy recommendations, some of which I will gloss over here. Number one, that the Environmental Protection Agency and the Department of Energy develop standards for very low energy intensities, low water usage, low noise generation, clean energy uses by operators, and standards that strengthen over time for additional carbon-free generation to match or exceed the additional electricity load of Bitcoin mining facilities. Should these measures prove ineffective at reducing impacts, the administration should explore executive actions, i.e. executive orders, and Congress might consider legislation to limit or eliminate the use of high energy intensity consensus mechanisms for crypto asset mining. In addition, the Department of Energy, in coordination with the Federal Energy Regulatory Commission, the North American Electric Reliability Corporation, and its regional entities, should conduct reliability assessments of current and projected crypto asset mining operations on electricity system reliability and adequacy. Additionally, the Energy Information Administration and other federal agencies should consider collecting and analyzing information and crypto asset miners, information from crypto asset miners and electrical utilities in privacy-preserving manners to enable evidence-based decisions on the energy and climate implications of crypto assets. It also says the administration will work closely with Congress to enable that the Department of Energy and encourage other federal regulators to promulgate and regularly update energy conservation standards for crypto asset mining equipment, blockchains, and other operations. They also want to encourage self-reporting by the industry and a bunch of other stuff. So takeaway here is, like I said at the beginning, the US government is starting to take a harder look at Bitcoin mining specifically, especially in light of Ethereum's move to proof of stake. This is cited in the report as a more energy efficient way to reach blockchain consensus. Obviously, we have a lot of problems with comparing proof of stake and proof of work side by side in terms of the guarantees that they deliver to their users in terms of security and actual censorship resistance, but that goes beyond the scope of this live stream. And just generally, the U.S. government and its regulatory bodies are really going to start reckoning with mining, especially considering a lot more mining goes on in the U.S. now in a post-China ban, in a post-China mining world than did, 1 or 2 years ago. The industry has absolutely flourished here over the past few years, and there are more Bitcoin miners and more energy being consumed here than ever before. Now, obviously, there are secondary effects to this, some of them good, some of them bad. Some of the good ones that I will say that the White House report actually recognizes is load balancing in places like Texas. They actually give Bitcoin miners their due in this article, while also, kind of taking the other side of the argument by saying more research needs to be done to figure out whether or not this is actually a good thing or whether or not miners are sucking up more energy than they are actually giving back to the grid. Additionally, this report on, I believe, page 23, is it? Yes, it talks about how Bitcoin mining can bootstrap renewables and also how it can be used to mitigate stranded methane. Now, it's nice to see this in here because this is obviously a drum that the Bitcoin mining industry and its proponents have been beating over the past year and even longer. Flared gas operations and even landfills that produce methane can provide Bitcoin mining with energy that reduces emissions on aggregate. And the White House, to give them their due, does seem to be saying that that is an area that shows promise and needs to be studied a little bit further. Now, one takeaway that I want to highlight from Craig Warmke he is part of Resistance Money. It's a collective of Bitcoin, pro Bitcoin academics who are writing a book to give the philosophical case for Bitcoin. He says academic research on Bitcoin is important, and it's not just about the White House cherry picking research. It's also about what's available, and much of it is bad. Craig makes a great point here. The White House is kind of grasping at straws in terms of what it can cite. Of course, there are things like Bitcoin Mining Council's research and industry-facing research that we produce at Luxor and other people produce. But, and to play devil's advocate there, obviously, Bitcoin miners and people embedded in the Bitcoin industry are going to produce research, sometimes critical, but oftentimes, makes the case for what they believe in, right? They're not going to always show the worst side of the arguments that we face. And, it's fair to say that we produce research and that the Bitcoin Mining Council produces research that makes Bitcoin look favorable, considering there is so much unfavorable research and writing that's put out in the mainstream media and mainstream academia. Now, all that to say that does not excuse the kind of writing and the kind of research that we usually see from people like Alex DeVries. But to Craig's point, we definitely need more honest, objective research in the realm of academia if we want a more balanced view of Bitcoin in policy papers and in reports such as this one. Now, this report, one more thing to highlight, is coming on the back of an executive order from Joe Biden called Ensuring Responsible Development of Digital Assets. And this executive order doesn't really do anything concrete now, but the thing that it does do is it starts opening up avenues for federal agencies to start researching Bitcoin, other cryptocurrencies, and CBDCs, and to make policy recommendations therein. So this again ties into some of the recommendations that we see in this report that I highlighted from this internal memo of the White House delegating to the EPA and Department of Energy to start looking at ways that they can develop standards for Bitcoin mining, and also to do kind of census and to do surveys with Bitcoin miners and other participants in this industry to see what the actual impact of this industry is. Now, all of that to say, takeaways from this just one more time. Some of the data that they cite is clearly skewed. Like Alex DeVray's Digital Economist data, Bitcoin mining does not use nearly as much energy as Alex would like to paint in his research, which has been widely cited by media. Some of the research that it cites, such as the Cambridge's Bitcoin Electricity Consumption Index, is more on the point, but even then, that could be on the higher end, according to other estimates from think tanks or from other researchers such as the Bitcoin Mining Council and ourselves. And one last time, this is again, I think, the cornerstone in terms of the White House and the U.S. government starting to construct a strategy on how they are going to address Bitcoin and Bitcoin mining. So I expect to see a lot more time spent by U.S. politicians and U.S. regulators in terms of taking a look at this industry. And I also expect there to be a lot more legislation and a lot more regulations to come down the road, especially from, I should say, not to be divisive, but especially from the Democratic wing of the U.S. government to try to address Bitcoin mining's energy use, because they see it as conflicting with climate goals that the party has set. Now, all of that said, the United States is not a monolith. It is a confederation of 50 states, and I imagine that if there was ever an overstep from the federal government to try to ban Bitcoin mining or to try to do something that the states felt were impacting their states' rights, you would see significant pushback. I do expect there to be a fight coming, but I do not think that the local governments who have benefited from the job creation and the taxation that Bitcoin mining brings, and also the grid balancing effects that it brings, to just roll over and take this, right? So all that to say, this report could very well be seen as one of the first shots fired in a coming war, one that is potentially could be harder on the Bitcoin mining industry or not. I don't want to be too alarmist. We have yet to see just how hard Washington will fight this industry. And it is our hope that they will take a more balanced view and let it thrive and flourish without, imposing any undue regulations and laws. All right, and with that in the book, we will now turn to last week's weekday newsletter, which was how much ETH hash rate can Ethereum Classic and other coins absorb? Now, it's kind of a segue from the White House report that we just covered. They do cover Ethereum and proof of stake, citing that it reduces Ethereum's energy and electricity load by 99.5%. Kind of a, loaded and skewed statistic there. But all of that to say, proof of stake will be used, I think, in the coming years as a kind of pointing finger at Bitcoin mining and say there are alternatives, right? But as miners, we know, and as we advocate, they don't include the same trade-offs. But all of that to say, now that Ethereum is set to go proof of stake this week, what does that mean for Ethereum's hash rate? Now, we posted a newsletter a few weeks ago in which we tackled this question looking at the viable alternatives. I think we covered it in our first live stream. It looks like most miners will look towards alternative chains like Ethereum Classic. Now, this is notwithstanding the ETH proof of work fork, which is still kind of up in the air as to whether or not miners will support that. I think that really depends long term on whether or not that chain accrues significant economic value. But as a follow up to that newsletter, we took a crack at looking at how much ETH Classic and other proof of work GPU mineable altcoins could take on from Ethereum's current hash rate. Now, for this article, we made some assumptions, obviously, because doing this pinpoint would be impossible because we cannot know every miner's energy use. We cannot know the efficiency of their hardware and things like that, and their just general margins. But in this profitability model we unpacked through this article, the data is current as of September 6, 2022, and the model assumes an average ETH mining hardware efficiency of 2.55 joules per mega hash, and also an average power cost of 0.06 kilowatt hours. Now, in reality, that power cost could be, obviously greater or lesser depending on the miner. Most retail miners have a higher electricity cost than that, and miners mining with industrial power or with behind the meter sources have probably a much lower electricity bill than that, right? And also, depending on the miner, their average efficiency could be greater or lesser than, but this is just kind of a middle of the road estimate we took for the sake of this exercise. Now, with all of that in mind, the analysis that we crunched generated the following. Ethereum Classic, as of September 6, could absorb roughly 10.34% of ETH's hash rate. That would be 93 terahashes a second. And this would mean that the average miner would reach their marginal cost, would reach a marginal gross profit, which basically is a break even of, they would reach that break even at 141.11 terahashes a second. Ravencoin could soak up roughly 3.68% of ETH's hash rate. This is 32.2 terahashes a second, and that would put Ravencoin's break-even hash rate for the average miner at 35.85%. And Ergo, a lesser-known proof-of-work mineable altcoin, could absorb roughly 1.56%, which is 13.67 terahashes, and would put the break-even hash rate at 37.13 terahashes a second. Now you can see we've got some charts in this article that kind of lay this out. And according to this analysis, that would leave about 84.12% of Ethereum's hash rate, which is nowhere to go, right? So basically, after the merge, we can expect the lion's share of Ethereum's hash rate to not go to any altcoins because it simply will not be competitive. And as you can see here, we have the current hash rate versus the break even according to this analysis. Now, obviously, this raises the question, what other alternatives are there? Now, we've seen from Hive and Hut 8, they've actually announced recently that they will look to do high performance computing, perhaps in the realm of AI and machine learning with some of their GPUs. For the big guys, obviously, this could be a feasible pivot. But for a lot of retail miners who are maybe operating a smaller scale or out of their homes and garages, this will not be possible. So we expect to see more GPUs flood the resale market in the coming weeks and months, as they already are. Now, taking some data from Tom's Hardware's GPU price index, the NVIDIA GeForce RTX 3090, which is a new gen GPU, has fallen 9.5% from July to August. Now, looking at eBay's own data for analyzing market trends, the same graphics card has fallen 68% year over year from the go-go days of Ethereum mining during the DeFi, explosion last year. It has drawn down 68%. Now, like I said, we expect to see more of this selling to come. GPU prices will continue to fall. And on this note, be on a lookout for an article on Hashrate Index this week around the time of the merge for kind of some projections on where we figure GPU prices might settle and some historical analysis for looking at correlations between GPU prices and times of Ethereum mining profitability. So kind of to cap that off, in a post-merge world, GPU mining as an industry will never be the same. It'll be indelibly changed. And, margins for these altcoins will not be nearly what they were for Ethereum. And without getting too hyperbolic about it, the merge kind of signals the death knell for the GPU mining industry. And we hate to see that as miners ourselves. We are proponents of all proof of work networks. Obviously, we focus on Bitcoin most of the time, but we did not want to see the merge go through because we have a lot of Ethereum miners on our pool, and we wanted to make sure that they still had a place that they could, produce their hash rate and earn a living from it. And it looks like after the merge goes through, that's not going to be as easy, if not impossible, for most of them. And so, on that, just cheery note, that concludes episode 3 of the Hashing It Out live stream. Thank you so much for tuning in. We're here every Monday, except when there are holidays or other disturbances, at 11 a.m. Central Daylight Time. Please give us a follow on Hashrate Index Twitter and on Luxor Tech Team's Twitter if you like this analysis and would like to see more of this in written form and on these live streams going forward. And if you have not, also please subscribe to the Hashrate Index blog. You can find it on Hashrate Index. Subscribe to our newsletter. You can find a subscribe button on the hashrateindex.com/blog landing page. And you can expect at least weekend content from us on the Hashrate Index Roundup. And when I get around to it, some weekday analysis like the one that I just ran through about Ethereum mining hash rate after the merge. And with that, hope you all have a great week. Deuces and happy hashing.